Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Tom Connors from Cathedral Energy Services. Cathedral trades on the TSX exchange under the symbol CET and on the OTC under CETEF. The company is currently trading at 69 cents with roughly 138 million shares outstanding, or about a $95 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Yes, we've been talking a lot about energy services over the last couple months, and very happy to have Tom with us today to talk about another energy service company that we're getting more and more familiar with, Cathedral Energy. Tom, thanks for joining us today, and I'm just going to hand it over to you, and you can start your presentation.
Good afternoon, everyone. Happy to join you today and tell you a little bit more about Cathedral. Cathedral is a pure play directional drilling provider. And I'll explain to you a little bit more what directional drilling is, just for people that may not be familiar with the space. But we've been in business since 1998. We're a public company. About 75% of our revenue comes from Canada right now, and roughly 25% of the US operations. So we're a North American footprint. And we're a full service provider. So what that means in the sense that we manufacture our own technology and deploy our own technology in the field versus someone who would buy from a third party vendor and be beholden to their design and times and updates and that type of thing for the technology. We are present in all the major resource plays in North America. The biggest one in Canada would be the Montney, or the most active for some of the best economics, the Montney and the Clearwater. And in the U.S., Permian, Haynesville, and Eagle Ford would be areas that would be active in today. So just to give you kind of an overview, and North Dakota, I guess we'll talk about that. Those we get into the presentation. So just for those who may not be familiar with the directional drilling space, you have a drilling rig at surface. And there's a steel drill string, and at the bottom of the drill string, right above the drill bit, is a mud motor, which effectively, so you pump fluids from surface, you pump mud. It goes through a drilling motor, and it's just designed so that it torques the fluid so that it spins the drill bit faster at parameters that you need to drill certain formations. The other component that we would provide is called a measurement while drilling system. So it's effectively a downhole GPS. So when you're drilling sideways now, when they're drilling well bores that are going out like 2 miles, and you've got a formation that is 3 feet thick, and you've got to stay in that formation. The GPS, the measurement while drilling tool, helps keep in formation. You know where you are, and then what I'd also say, and I'll comment on a little bit more later, it's just the reliability of that technology, because you're right behind a drill bit, so there's a lot of vibration, and you're pounding on rock, and you're going at high rates of speed. So it's got to be reliable, because when I was involved with drilling, one of the first wells in the Duvernay here in Canada a few years ago. That took 45 days. Well, we're drilling those wells in 11 days now on a consistent basis. And as you do that, and your overhead on location is about $200,000 a day, you don't want to be 4 days into a well and have to pull back out to replace the NWD tool. So the reliability and performance of tools becomes really important. So we're a relatively large mud motor company. We have 1,127 motors, which is significant in North America, and about 100 NWD kit capacity. So what's changed with CET? So a new management team. I spent the last close to 20 years or so with Ensign Energy Services running Canadian operations. I was part of the executive committee working with Murray Edwards. We had 7 different business lines. $2 billion in assets, 1,000 or more employees. And I started the directional drilling business for Ensign. We actually started in the DJ Basin, because we were doing what's called turnkey work, where we were flat summing wells to the operator and supplying all the services. We were hiring our own directional drilling contractors and said, hey, why don't we do this ourselves? We had some success. And then we grew into Canada through acquisition and built a business that way. are still in the business today, but not as large as what we were in the past. We've also got a new CFO, came over from Trican. We've got a new leader for our US group, who came over from Precision. And effectively, you know, over the last year, really focused the plan on trying to grow size and scale for the business. And I joined the company because I'd competed with Cathedral for a number of years. So they've always had a great platform, good operations, good technology, good people, and saw it as a company that really could get back to being one of the larger pure play North American directional drilling contractors again. It had all the ingredients to make that happen, and I thought it was just a matter of taking the right plan and the right people to put it in place. We have two large strategic shareholders, so Precision, and I'll talk a little bit more about that, joined, invested in the business, rolled in their directional drilling business, invested some cash. They're a significant shareholder. They're a long-term supportive strategic shareholder. They believe in consolidation in the space, and they believe in the drilling technology automation. And what the part, so you get to a point where a drilling rig, you could actually program it, it'll just drill the well, but you need to be able to communicate with an MWD tool to help enable that to happen. And they wanted to work with someone who had the capacity and the capability to develop that technology. Management and the board has been increasing their investment in the business substantially over the last year or so. We now own about 18% of the company. We've just commercialized the latest generation of MWD platform called Rapid Fire, and we've completed 3 acquisitions in a $25 to $26 million bought deal here in the last, at the end of April 25th. So what's changed in the markets? It's a little bit more, I think what's important to understand is that as we continue to manufacture well bores and continue to engineer inefficiencies out of the business, and as I alluded to earlier, you take wells from 45 days down to 11, and they're going up further than they ever have. They're going further sideways. So you drill down and then you go sideways through the formation up to 2, in some cases 3 miles. The only real limitation is how far that they can, is completions technology. But they really are drilling at the technical limits of the equipment. It's just, you know, a drilling rig can't simply make a connection that faster, or, you know, a top drive can't work any faster, or you're getting at those and you're doing it on a consistent basis. So the productivity has improved substantially, particularly over the last decade. There's also what's called rotary steerable, which has been an offshore application. As you get into these resource plays, so the Permian in the US, there's a bunch of the most prolific ones would be the Permian in the US or the Montney here in Canada. There's much more abundant use of, because they can go further and more seamlessly. They can cut time off well by using a rotary steerable application, which effectively just means you can keep rotating as you, versus the conventional way of building angle and turning sideways. But that does create a higher demand for a higher performance product. So I guess what I'm trying is the market's bifurcating. The people and the companies that can provide the technology that can perform at the criteria and the levels that the customers are demanding today is becoming much different than those that can't. If he's just buying off the shelf technology, you're subject to the updates and upgrades of a particular vendor who may not be as close to the customer and is not as nimble and agile as somebody who develops their own technology might be. And then, of course, the focus the last few years, compressed drilling budgets, capital discipline, relentless focus on efficiency, and just drilling programs engineered, like I said earlier, to go at the technical limits of the equipment. So all of that drives, you know, a demand for high performance and high reliability tools. And there's becoming a difference between those that can provide it and those that can't. And if you look at what's happened in Canada the last few years, in 2014, there were 30 directional drilling companies. So then you layer on a downturn. It started in 2015. There's 13. A couple of weeks ago, it would have been 14. Today, there's 13 companies, the top 3 of which are Cathedral, Pacesetter, which is 100% owned by Schlumberger, and Phoenix Technologies, or PHX Technologies. Between the 3 of us, we have about 60–65% market share in Canada. So that consolidation has also allowed for, you know, larger businesses or more mature companies who can generate the free cash flow to reinvest in the technology, and again, further differentiate from a private contractor who's not generating enough free cash flow to reinvest back in his equipment. So we have what would call our three strategic growth pillars: technologies, consolidation, organic growth. Organic growth is just really being focused and disciplined around, your cost of service delivery, making sure that we're delivering from a service quality point of view, and that we are maintaining our market share, that we have best in industry class mean time between failure numbers, and we have to be a top quartile performer, or you just can't stay in the game. So, for companies like us and or Phoenix, again, I would just say it's the top quarter. Those that are providing that technology and can deliver and execute on it consistently are being bifurcated from those that are having a tough time sustaining the pace of technological change and performance. So technology would be, I talked a little bit about the drilling automation. Again, as drilling automation continues to evolve, and it's come a long way the last 10 years. You will still need people on drilling rigs, but there's not people. It's not like the old rig you see in the past. In a lot of cases, there's no people involved with making connections. It's a much safer work environment than it would have been 10 or 15 years ago. And they continue to evolve around drilling controls and automation. But the missing link in a lot of cases is the communication, ability for the rig to communicate with the downhole GPS and understand what's happening below ground. And that technology was a bit of a push, particularly by the larger tier 1 operators that want to get to a point where they can just go rent an MWD technology or the motor technology, pair it with the rig, and they can monitor the wells from a remote location. And that's probably evolving a little faster in the US than in Canada, but we believe Cathedral can lead the progression of technology that way, particularly because we develop our own MWD platform. So that is a big initiative in the sense that we want to lead that and not be left behind by it as the market evolves. Rotary steerable technology is another differentiator, and then just continuing to build out a bulletproof, really solid MWD platform. Our biggest focus and our biggest area of growth has been through consolidation. So I talked a little bit about the technology already, so I'll focus a little more on consolidation. So why is consolidation important, or why consolidation now? I think, again, I would primarily focus. You've got a lot of private companies. There hasn't been a lot of consolidation. There's never really been any consolidation in the directional drilling vertical. There has been consolidation in the drilling space, the fracking space. So dominated, fragmented by private players that have struggled to generate enough free cash flow to stay current with their technology, their equipment. You've also got a bit of an aging, population, sense that some owner operators are getting retirement age and they need an exit. And I think there's just a general understanding that size and scale matters. You've got to have enough scale to reinvest, to have the economies to generate the free cash flow, to stay current with at the pace that technologies change over the last decade. And if you want to stay current with that, you've got to continually reinvest, and you've got to be able to provide the technology that performs at the levels that the customers demand it. And it's harder to do that as a 5-kit private operator. There are relatively compressed valuations in the space right now versus historical multiples. We believe that we're at early stages of a recovery in the energy space broadly. I would just say, if you look at the lack of investment in global energy infrastructure the last 5 to 7 years, demand really hasn't changed, but the investment has gone like this. So it really would be difficult to globally to bring on supply in the short term that could possibly keep up with demand. So we're going to have tight supply-demand fundamentals for some period of time in the future. It is difficult in oilfield services to bet longer than 3 years, but our theory would be that we've got at least 3 good years in front of us. So we want to execute a strategy where we can effectively put a moat around the company through size and scale, getting as big as we can, as early as we can in the cycle, and then creating a bit of an oligarchy in the sense that you could really dominate 2 or 3 people, 2 or 3 companies. You effectively create an oligarchy and dominate the space. So you have a little bit more, you will have more discipline. We're already seeing that in Canada around pricing. You have the maturity and the wherewithal to continue to deliver the technology. And you just get a kind of a more mature industry and sector going forward, dominated by larger players. And that seems to be what is playing out. The other attractive and why consolidation is, from our point of view, if you look at Again, versus drilling rigs where it's going to cost me $35 to $40 million to build a rig, and I have $1 million every so many years to recertify it, and the top drive costs $1 million, a mud pump costs $1 million. The capital intensity around the directional drilling business is far lower than it is in other sectors like drilling or fracking. So yes, we do have to spend continually to stay current with technology, but we would generally have to spend 25 to 30% of our EBITDA to kind of keep up with the technology, and just in a slow year you could cut that obviously, but just as a kind of a regular run rate, that's what we would see. So if you had a business that was generating $75 million and 25 million capex, you get 50 million free cash flow. So free cash flow profile in the directional drilling space would be pretty attractive. So if you've got the volumes, if you've got the market share, the capacity to deliver free cash flow is fairly substantial versus other sectors. And then, and correspondingly, because you're not as asset intensive, your depreciation is lower, so you also get the net earnings much quicker. And we saw that, in Q1 of this year, we were positive net earnings versus other sectors like drilling or fracking. Again, we're much more capital intensive and higher levels of depreciation, and will be a while before they see consistent years of net earnings. Our consolidation strategy is, for us, you're bringing on income, you're really buying incremental market share, and then you can deploy the technology as things go forward. You use up their technology, and then you slowly introduce yours over time. But it really is about acquiring proven management teams that are willing to take some equity and be aligned with the growth of the business forward. We would typically target 50% debt, 50% equity. We don't want to take on any more than 1x debt to EBITDA, kind of pro forma EBITDA. We want a profile to get down to being close to debt free within 12 to 18 months after an acquisition. We would only do deals that are accretive, and that's why at this point, with an improving outlook, and I would say with a lot of capitulation, a lot of fatigue in the market from different management teams, and really with no way out, with no way to get liquidity, we are pretty much the only logical consolidator in the directional drilling space. Phoenix is pretty satisfied with their market share. They're focused on their international growth. They're really focused on just deploying more of their technology and trying to grow that way. There's another public company in the US called KLX. They're a little bit more diversified. They're struggling in the space, as I understand it. So, and there's not a lot of PE money. There's maybe some family PE monies, but there are really not a lot of logical consolidators. And so we see there's some great management teams that are available. You can get them for good multiples. You can do it early in the space, and you can really fairly rapidly grow your EBITDA and cash flow profile, and all of a sudden you've got a much more sustainable and durable entity than you had before. We've completed 3 acquisitions in the last year. The first one, as I mentioned earlier, was Precision Drilling. I wasn't here very long. I'd worked with the Precision management team for a number of years. I'd sat on boards with them. They were at a crossroads with their business. And they just said, look, we would like to have a conversation about rolling our business into Cathedral. We would rather be a partial shareholder, or a part owner, I should say, or a substantial shareholder in a business that can focus on it full time, than own something 100% and only being able to dedicate a part-time focus. So their thought was we could do more with their assets than they could. They rolled in their assets for a discount, really, and $3 million cash to allow us to invest further. They were renting a fair number of assets at the time, in third party. So roll in the cash that allow us to get rid of the rentals and improve the margins of the business, and a building that we sold later for cash. And Precision got 13.4 million shares, or at the time 17.7% of the company. They're a long-term strategic shareholder. We have a marketing alliance and a technology alliance for developing automated MWD tools, and we basically have we work on customer. They have a great footprint in the US and Canada, good operations footprint, well-regarded company with a good reputation. So our sales groups work together on, I would say, targeted referrals. If there's certain customers that they would have an established relationship, we can work with to help introduce the directional services to them. And if they have any turnkey work where Precision is effectively the general contractor, we automatically get that work. So, for example, in the US, we're on 2 Precision rigs today. We acquired a company called Valiant Energy Services in September of 21. The president of the company basically, I've met with him a couple of times. He said, look, I'm sick and tired of competing against you guys. I know I'm going to have to invest a bunch of money to keep up, and I'd rather just roll in with you. I could take some shares. I have your technology to introduce to my customers, and I can help grow the business forward. So we bought his assets for net book value. Effectively, we issued $1.5 million worth of shares at the time for the net value of his equipment. And we had a performance incentive going forward to help him, to incentivize him to build and grow and stay with the company for a number of years. And then in February of this year, February 10th, we closed a mud motor technology rental business in the US. A couple of reasons why we like that platform is the US is a bit more of an a la carte model. There 60 to 65% of the revenue is directly to E&P customers. They're 60% of the revenue comes from Midland, Texas, and then the rest is split almost evenly between Casper, Wyoming, which is the DJ Basin, and North Dakota, which is actually an improving market. So we thought they had a very current mud motor technology fleet. It was complementary to ours, a great sales platform selling directly to E&P, and it kind of fit with the evolution of the market in terms of more the a la carte model. 2019, they did 25 million revenue. It's not a very labor intensive business, so 50 to 60% gross margins and 30 to 35% EBITDA margins. We just had the last couple of months have been record months for us for Discovery. So we're more than on track to beat the 2022 activity levels look similar to 2019. So revenue, we expect 25 to 30 million, again, 50 to 60% gross margins, 30 to 35% EBITDA margins, and that has been playing out in the market in the US for us. We're actually fully utilized today, so we're looking at ways to kind of expand the assets we can, or use some Cathedral assets to deploy in a rental model down there to help continue to grow revenue. It's also a model we could introduce other products, not just mud motor technology, and that we can effectively have a technology rental business and a full service directional business in the US that would complement each other. So the result of those three, and we did announce on Monday a further acquisition that was really more around technology, Alexa Technologies. Axel Smith is a well-known, well-regarded person in the industry. He's got a proven history and capacity, particularly around MWD and rotary steerable technology. As we look to the US market and really building out a bulletproof MWD platform, Axel's background and strength was something we thought could really help add value in the future. So that's just another piece of the strategy and differentiation going forward. But if you look at the combination of where we were into the impact and the torque provided by 3 acquisitions in the last year, revenue going 2020 was a rough year for everyone, but from 41 to 2023, these are Peter's forecasts. I just want to make sure I'm clear about that these are not these aren't our forecasts, but the one analyst that does cover us, this is so we've got 190 million revenue in 2023, 44 million revenue in 2023, EBITDA, sorry, in 2023, and 36 million free cash flow. And so as we look at that profile and say, what are the opportunities to expand? If we, through consolidation, if we can further expand that profile and the free cash flow that the business can throw off, is fairly impressive. And one thing we're particularly proud of, I think is important, is we exited 2020 with 8% market share in Canada. And with the combination of the acquisitions through 2021, we exited Q1 22 with 20% market share, which was higher than PHX, and second, I guess, number 2 behind Schlumberger, and they dominate the rotary steerable space here in Canada. So that's why they get a little bit higher market share than everyone else. But again, the top 3 players all kind of being that 18 to 20% market share range. So a balance sheet, we just bought deal financing. We have cash in the bank today. We do have a little bit of debt just that we took on for the Discovery acquisition. But we'd effectively, if you took out the right of use assets, we'd be 0 net debt today. And the right of use assets, which some people include, some don't, are just the lease liabilities in the future, our projections as well. Okay, so 31 this year, 44 next year in terms of EBITDA, fairly clean balance sheet. And really the bought deal financing, as more than anything, was about just furthering our consolidation strategy, getting ourselves in a position to execute on more deals, to go forward, and making sure that we strengthen the balance sheet to give ourselves the best possible success of executing on potentially some larger transactions, particularly in the US. So in summary, that we believe we're poised to become, we're the only logical consolidator in the space. We're poised to become a leading North American directional drilling contractor, one of the more sizable ones for sure. That would mean 25 to 30% market share in Canada and somewhere 5 to 10% market share in the US. We've been in active discussions with the pipeline of a number of different opportunities, ranging in size. Some, in Canada would be more technical, tuck-in type acquisitions that would complement if they added a market area or space we weren't currently in, would help expand the customer base. We would look at that. But in the US, you got Phoenix is the largest, and you'd have 2 or 3 larger directional drilling contractors that would be in that 40 to 50 job range, and then there'd be a few in the 20 job range, and then you get down to several in the 5 to 10 job range, but all private, other than technically 2 other public companies, but 1 of any really substantial size. So we believe that we could execute on a larger transaction that would have something like 34 or 35 to $40 million EBITDA US, that we could get a transaction done with 2.5 to 3 times at EV to EBITDA type of profile, and multiples, so we still get them done for attractive valuations, and that we can do it in a way that doesn't take on too much leverage, and that we would issue equity to potential management or ownership groups that keep them aligned and help them, keep them incentivized to help continue to build and grow the business forward. So, I guess why Cathedral, or in summary, we've got a new management team focused on growth. We've got a track record of consolidation. We think there's some great opportunities to really change the trajectory of our EBITDA and free cash flow profile, that we can get that done for attractive valuations, that we will only do deals that are accretive, so that everything we do have to be accretive to shareholders, and that we would want to make sure we identify and lock up or align the right management teams with the growth of the company forward, and really put Cathedral in a place that's a much more substantial, sustainable, and durable company in the future. And then once you've got that free cash flow profile, then things, either you continue to deploy capital to grow the business, or you share buyback, dividends, whatever. It's just there's more options into the future. That's not likely things that we're focused on right now today. It's pure growth or consolidation, because we think we can drive more value that way. You do certainly have more optionality as you grow the trajectory of free cash flow and EBITDA. So
Perfect. Thank you. You've covered off a whole bunch of the questions that I was, lined up to ask you. So you've done my job for me. A big piece of the business is M&A. You talked to a little bit about sort of where you want to sort of go with or what the pipeline kind of looks like. But with the fact that you guys are 75% in Canada, or 75% of your revenue comes from Canada, 25% in the US, can an investor assume that you're going to try to balance that out, or is that something you're driving?
Yeah, no, I'm perfectly fine saying that our focus right now would be more in the US. It's a much larger market. You don't have the same seasonality you get in Canada, so you get a more continuous cycle. Here in Canada, every year you get spring breakup. Activity, you get a big Q1 bump, and then you get Q2 drops. You don't get that in the US, and you tend to get higher levels of utilization. And the pricing and margins are better in the US business. So, our primary focus, or at least if we were going to do a more substantial transaction, that would be more US focused. In Canada, it would be more incremental moves. US, our focus is US based and primarily kind of Texas or Permian based, because if you're going to be in the US, you have to be in the Permian.
And then I guess secondary to that, if you're going to go out and acquire other companies, you've just done a bought deal financing a little while ago. I would assume that the sort of the capital markets are a lot more open to you guys than they were, say 2-3 years ago. But maybe talk to that a little bit. What's it like now talking to investment bankers? What's it like to talk to investors? What's sort of the investment sentiment out there from your standpoint?
It's certainly shifted over the last few months. I think if, my own personal view would be that if you look at all the other sectors, and you're looking for returns, that you look at what energy's been throwing off the last few years, or the E&P companies have had a pretty good uplift the last 12 months. And normally what follows after that is OFS companies, because as CapEx and investment increases and improves, it has to translate to improved OFS activity. And I think people are starting to recognize that I want to get returns. If I look at some of the, what E&Ps have been doing, the next turn could be the OFS space. So they're starting to look at it as an opportunity again. And I think there's just a general more pragmatism around. I think people are starting to realize that even the whole conversation around a transition, that we've got to be more pragmatic about it. It's going to take a longer period of time. So that maybe we've got to take a real hard crack. And then if you look at the valuations in some of the energy space, that it warrants a good practical look at the energy space again, and both E&Ps and OFS companies. So I would just say some of the comments, there's been a lot of generalist investors looking back at or starting to look at where the value is in the space again. And, so some of the comments I get, maybe guys say jokingly, but, hey, the space is starting to look sexy again, that type of thing. It certainly feels like it's early stages, but I think there's a lot more positive sentiment around the space in general.
Clearly, you're talking to a lot of the E&Ps and sort of the customers out there. With oil, natural gas prices where they're at right now, we've heard a lot about discipline amongst sort of the E&P players out there. They want to return cash back to shareholders, and they're not likely to drill as much or to sort of get back in the fields. What are you seeing? And what's sort of the dialogue you're getting into with some of these guys about that sort of type of mindset?
I think it's absolutely true. They are more disciplined, and it's not the Wild West days it was. And I think it's a good thing. If you look at the operators in general, they really are focused on delivering shareholder value. Whether it be that through dividends, special dividends, share buybacks, whatever the case is, and they still have to grow. This business, you do have decline rates are real, and you have to keep drilling to a degree just to keep your production profile flat. And then on top of that, at these commodity price levels, just the amount of cash flow, even if their CapEx percentage is the same, pure dollars are growing, and so the amount of dollars are going to translate to increased OFS activity. So I actually think it's a good thing for the space. That I don't think it'll get so frothy that you get the silly money running back in, where people are starting companies and building rigs without, with shaky economics, that type of thing. So I think all the more reason why it supports our strategy of, if you're a bigger player in the space, you're going to be able to drive and earn good returns and deliver good value, but you're not going to have kind of the silly, undisciplined capital getting spent, things happening, and a whole new competitive cycle starting all over again. So I think it's a more mature point in the cycle, and with an improving outlook. So I think that those are all good things for the industry.
Now, in speaking with other companies that service the industry, what we're hearing a lot about recently is that, you guys are able to actually push out some price increases, or customers are more accepting of sort of the challenges you guys are facing. Are you seeing that? Are you able to, sort of either, get more business or increase your pricing?
Yeah, the interesting thing is it kind of follows on the capital discipline line as well. People may be increasing their CapEx, but they're also anticipating, because of everything you hear in the market and what people are seeing, they know that there's some inflation coming, and that the inflation is real. And so they're the operators are understanding that price increases have to happen. So I would say we started increasing prices off the trough in about mid-2021. about 8 to 10% increases through there, which mostly kept pace with cost and labor inflation as activity started to improve. But as we get into the first half of this year in Canada, now we're pushing through kind of more like an average 15% price increases, which are not just covering inflation, but there's some margin expansion there as well. And we are getting that push through, particularly as we just went through a bid cycle here in Canada. For the starting Q3 activity as we come out of spring breakup, and the new contracts are generally at higher pricing than they were. And in the US, we're seeing, the US always seems to rebound quicker at pricing, but it's been more like 20 to 30% increases in the first half of this year.
Mm-hmm. Mm-hmm. Gotcha. And speaking of inflation, where are you seeing inflationary pressures, and sort of secondary to that, what other challenges are you facing, running your business?
I would say almost directly linked. One of is labor constraint. It's a tight labor pool. I mean, more so like the U.S. as well. I was going to say it was more of a prolonged downturn in Canada than it was in the U.S. Canada really hasn't recovered since 2015. So a lot of people left the industry and just haven't come back. Nobody sits at home and waits for a job for 5 years. So I would say we're constrained on experienced labor. Being a larger provider of the service, we do have kind of a more of a stable, experienced people that we can build off of. But there's only so much capacity in the industry. Period. There's only so much capacity for the technology. There's only so much capacity for experienced people. So that would be one. Supply chain, if we were to try and build out, if anything, if we were trying to grow organically right now and build more mud motors or more MWD, that would be a constraint. It would be hard to deliver excess capacity or to build excess capacity with equipment. It would take 6 to 12 months, to kind of really, depending on what it was you're doing, but it could take as long as 12 months. And then just general, I mean, our constraint is people, and our biggest area of inflation is people. So to give you some context, at the peak, directional drillers would have got paid $1,200 a day. At the trough in 2020, that got down to about $400 a day, and that's come back to about, you're kind of in that $800 to $900 a day range now. So not quite back to peak pricing, but it has moved up to the trough.
Mm-hmm.
And then just in general inflation, I think we're a little bit insulated because we do have we have buffer and inventory with the acquisitions we've executed. There's some parts and pieces that we could burn through there before we really get pinched by supply chain, which also has the advantage of being able to use some repair and maintenance, some existing inventory for repair and maintenance to keep our costs down versus paying new price for new items. But that'll only last for so long, and at some point we are gonna have some cost increases on our end as well for different components.
Mm-hmm. And maybe an odd question, but is there any ESG angle to your business? Are you doing anything better than others, or is there energy savings, cost savings, things like that you guys are able to demonstrate?
Well, I think one of the areas where that's why we're really focused on our remote platform and removing people from locations. When you think about 4 people and 4 different vehicles and lodgings and everything else surrounding all that, if we can remove people from location and get to a standalone automated MWD tool that you can effectively just send out to a drilling rig, that's going to go a long way towards just reducing some emissions and just getting kids safer, because you get people off the highway, which is the most dangerous part of our delivering service these days. Driving is the highest incident rate. But I would say primarily that's the biggest thing. And then we're also diverse, geothermal, potash, lithium, other areas that we can deliver services as well. We're active in potash and lithium today, and geothermal. So trying to move into other sectors where we can deploy directional drilling technology, and I think our biggest opportunity is to just reduce people off location and more remote application of technology, and also just trying to find technology that less off-gassing, that type of thing, just more environmentally friendly technology. We are actually focused on developing that type of thing or evolving that as well.
Fantastic. Okay, so a question came in regarding your financials, and the question is, can investors expect adjusted gross margins to stay around the 29% plus that we saw in Q1? Is that, now I understand Q2 obviously, is seasonally slower. I don't know what kind of margins you can imagine sort of into that quarter, but sort of longer term, what sort of are the margin expectations?
Yeah, I mean, you're right. Q2 is always, because it's also earnings season, bring everything back in its hair, so compressive margins a bit. But if I normalize, over 12-month period, certainly would expect it to be in the 28 to 30%, or between 20 and 35% is what I've been looking for kind of going forward as we get price increases. And with our model, because we've got our engineering costs are fixed. So as we drive more volume through, then more should flow through to the bottom line. So it's some slight margin expansion offset by inflation. So I'd expect to be in that kind of 28 to 35% range.
Mm-hmm. Now, I'm going to throw you a bit of a curveball question here. You're clearly in the industry and sort of see where the action is. Is there any area, geographically speaking, that you think investors, if they really want to see where some either exciting things are happening, what area would you point us towards? The U.S., the Permian, the Clearwater. Where do you think there's action happening here that makes we should be watching it?
I think there's a number. I think if you look at, high level, the gas market in particular is going to have a lot of legs in the future. And if you really look at how that translates in the Canadian marketplace going forward, everyone thinks Canada's primarily oil. But it really has been the gas market, if you look historically, that's really made a difference here. And if you look at, we're a year or two out, from coastal pipeline being built, and that's going to require 2,000 wells a year getting drilled. That's a lot of activity right now. So that is a difference maker. I would say in Canada, to look at the Montney, because Canada still is an importer of diluent today. So we, for the oil sands, the Montney, not only does it have gas, but it has condensate, for diluent for the oil sands. So, that's got strong economics and has kept it relatively busy all through the downturn. So the Montney is an exciting area. And then an evolving play the last 2 or 3 years in Canada will be the Clearwater. Cathedral actually dominates the Clearwater for 20 rigs running in the Clearwater in Q1. We were on 15 to 16 of them at different times in the quarter. And then what they do is it almost looks like herringbones. They go down one single well and they do multiple laterals, and they actually go down another level below and do the same thing again. Economics are quite attractive in that area, and so there's 2 reasons why we are strong in that area. One is our EM technology is considered some of the best in the industry, and then second, we're one of the only companies to have developed a downhole generator. So what happens is normally directional drilling providers supply batteries that power the NWD tool, and then the batteries die and you have to pull out the place. And our generator, you can stay underground for 200 hours without having to worry about batteries, that type of thing. So it's proven to be a bit of an advantage, and we built out a good platform there. In the U.S., the Permian is for sure it is the market to be in, the largest market. We just look at the number of rigs and everything else, and it will be for some time. Well, I don't think it's going to be able to bring on production like it did in the past. And a lot of the tier 1 properties have been drilled, the decline rates and everything. It's a significant play and will continue to be. But then again, if you look at the gas market, Haynesville in East Texas is closer to market and able to deliver gas, and it's really picking up in activity. So it's the Haynesville is an area to look at right now.
Fantastic. We talk so much about sort of innovation and technology around your company. Try to give us a sense of the brains behind the business here, because it sounds like there's some really neat technology you guys are developing for some crucial issues out there.
Yeah, I would always kind of compare it, if there was a tech play in oil field services, it's in the directional drilling space for sure. And I would say it is more of a people play. rigs, if I've got a rig that's spec'd the right way, then, you know, the rig sometimes almost sells itself. I just got to make sure I've got a rig that's spec'd properly. But in the directional business, it is about deploying the right technology and knowing how to do that. So, I mean, we've got a long history of, you know, Randy Stanek has got a number of patents. He started out with, you know, Sperry, which is later bought by Halliburton, and, you know, has been in the industry since, I don't know, Randy's in his early 60s, but he's certainly been around a long time and developed a lot of, and I think maybe I'll summarize it this way. Our mud motors are, if you ask people generally in the industry about Cathedral, they would say that we have some of the best mud motors in the business. And Randy's really been the brains and developer behind the mud motor technology for a long period of time. We've also had some long-term employees, but very, you know, people, a lot of 20-year employees here that have been involved in the technology side, so very little turnover there. And so people, you know, we've got an established brand and platform to build from. So we haven't lost any of that kind of experience, interest, but and now with Axel coming in, I think it'll be there's some succession there over time for Randy, but we think we've got now one of the better minds in the business as well to continue developing the platform. But there's two components: the mud motor technology, which is really about producing something that can spin the drill bit faster and perform at the rates people want and not blow up with, you know, at the high rates of speed and vibration. And then the MWD tool, which is effectively a downhole computer. So you're going to put a computer right behind a drill bit and vibrate it at high speeds. It doesn't tend to do well for computers. So having the technology and the know-how and the expertise around that is really helpful. And we think we've got some of the best known people in the industry that have developed this stuff for years. And we've got a bit of a platform that we, you know, to build from 20 years of history and legacy experience.
Yeah, no, definitely sounds very impressive. Listen, sort of we're at the end here. As investors sort of watching from the outside, what do you think are the key things that we should be sort of paying attention to, either, you know, maybe industry metrics or, you know, company catalysts or anything within the company as far as, you know, data that we can follow that really shows us that you guys are executing on your business plan?
Yeah, so the number one thing for me is I mean, the opportunity for further consolidation to expand our EBITDA profile from, you know, the kind of the 35 million-ish fairway to something more like the 75-80 million kind of fairway. We're focused on those types of opportunities this year, and we, you know, really think it's important to get there as early as we can in the cycle. So we're focused on that. So I would say, you know, is it an opportunity to take a company from, you know, where we were last year, you know, from a $20 million market cap to a $200 million plus market cap? We think that exists with Cathedral. We think it's a great existing platform. And when you look at us versus, say, other competitors in the space that might be larger, I don't generally like rather talk about what we're doing to build and grow the business. But if you look at multiples, we get a bit of a size discount right now. We're smaller. And as we grow bigger, there also should be an opportunity for multiple expansion to trade closer to some larger companies and those types of valuations. And I also think in the future, as investors start to take another hard look back at the space again, and we look at the performance and the type of returns to be driven, particularly these commodity prices, which look like they're here for a while, then we should have an opportunity for further multiple expansion beyond that for the whole sector.
Fantastic. And then this is your opportunity right now to sort of give a key takeaway or key message. What do you want to make sure that everybody walks away with today knowing about Cathedral?
I think well positioned to be, you know, a larger player in the North American directional drilling space.
Fantastic, fantastic. Appreciate it. So we've been speaking with CEO Tom Connors of Cathedral Energy Services, symbol CET on the TSX. Tom, I want to thank you for joining us today, and certainly look forward to catching up with you in the near future.
Thank you very much for arranging this today, and thanks for your time, everyone.